Hello, and welcome everyone. Today we're going to unpack one of the most powerful, proven, and talked about investment strategies in the world, putting your money into the S&P 500. If you've heard about it but never really understood how it works, or you've wondered why so many experts and even billionaires recommend it, this is going to be your complete plain language breakdown. The S&P 500, short for Standard & Poor's 500, index is a benchmark that tracks the performance of the 500 largest publicly traded companies in the United States, covering a huge range of industries from technology to healthcare, finance, energy, and consumer goods. Think of it as a giant snapshot of the U.S. economy. These companies must meet strict requirements to qualify, including being based in the U.S., having a float, the portion of shares available to public investors, of at least $50 million, and maintaining a high enough level of liquidity and market cap total value of all outstanding shares. As of August 2025, the index includes companies like Apple, Microsoft, Google, Amazon, Tesla, and scores more. It's designed to represent the overall health and trajectory of American capitalism, giving you exposure to a vast cross-section of the country's economic activity. Now, you don't actually buy the S&P 500 itself. Instead, you own a tiny piece of all of them through something called an index fund, or an ETF, exchange-traded fund, like the Vanguard S&P 500 ETF, or the SPDR's S&P 500 ETF, which automatically holds the entire basket of companies for you. This makes it super convenient, requiring almost zero effort on your part once set up. It's also one of the lowest cost ways to invest, because the S&P 500 is so popular and well established. These funds sometimes charge fees as low as 0.03%, meaning you pay less than 30 cents per year for every $10,000 you have invested. The reason they're so cheap is that index funds don't require active management. There's no team of analysts trying to pick stocks that will outperform. They simply mirror the composition of the index, buying and selling as each company rises or falls in value. This straightforward approach has made them the darling of the investing world. To invest in the S&P 500, open a brokerage account with online platforms like Fidelity, Vanguard, or Charles Schwab. From there, search for the ticker symbol of your chosen fund, such as VOO for Vanguard's fund or SPY for SPDR's. Choose the amount you want to invest and buy. You can start with as little as a few dollars thanks to fractional share investing. And that's pretty much it. You'll receive shares equal to the percentage of the fund that your investment buys. For example, with around $450, you can purchase one share of the Vanguard S&P 500 ETF with the SPDR fund. It's around $410 per share. Prices change daily. Now, why is this seemingly simple strategy considered one of the best and most reliable in the world? Why do so many of the world's top investors and business leaders like Warren Buffett, Peter Lynch, Charlie Munger, Larry Fink, Bill Gates, and Ray Dalio swear by it? Why did Jack Dorsey, the co-founder of Twitter and Square, instruct his AI to invest his money in the S&P 500? The answer lies in four crucial advantages. First, diversification. The S&P 500 gives you exposure to 500 of the most successful companies in the United States across dozens of industries, averaging about 13% annual growth over the past century. Instead of picking individual stocks, you own a slice of the whole pie, reducing your risk significantly. Second, it requires almost no effort. Unlike actively managed funds, index funds don't demand constant monitoring and adjustment. Once you invest, your portfolio automatically mirrors the market. This frees up your time to focus on other aspects of your life. Third, it's incredibly cheap. Fees are typically less than 0.1%. That's 1/10 of what you typically pay for actively managed funds. Keeping more of your money invested makes a big difference over decades. Fourth, it's simple. You don't need a fancy degree in finance or economics to understand this strategy. Invest consistently over time and let compounding interest work its magic. It's a powerful combination. Now, let's talk numbers. How has the S&P 500 performed historically? What are its future prospects? Let's look back first. Since its inception in 1957, the S&P 500 has grown substantially. The total return, including dividends, has averaged about 10.5% annually. That means a $100 investment in 1957 would have turned into more than $170,000 by 2025. Of course, this doesn't account for inflation, which means your purchasing power would have increased much less dramatically. However, considering that the S&P 500 has outperformed other asset classes like bonds, gold, and real estate over the long term, it's still an impressive feat. This success has been driven largely by the increasing profitability and reinvestment of earnings by companies within the index. Looking forward, opinions differ. Goldman Sachs forecasts the index could climb to around 6,900 points within 12 months, driven by continued earnings growth and strong expectations for 2026. though they caution that over the next decade, annual returns could slow to around 3% because of today's high starting valuations, up 20% year-to-date in 2025. That surge has been fueled by incredible gains in major technology, names often called the Magnificent Seven like Apple, Microsoft, Nvidia, Alphabet, Amazon, Tesla, and Meta riding the wave of artificial intelligence breakthroughs, cloud computing growth, and rapid adoption of new technologies. Some highly optimistic voices, like Tom Lee from Fundstrat, imagine the index soaring to 15,000 by 2030 if demographic trends, generational wealth transfers, and technological innovation all align perfectly. Meanwhile, more cautious long-term players like Vanguard expect 4% to 6% annual returns over the coming decade, citing expensive valuations as a natural brake on future gains. It's important to remember that no one can predict the market with accuracy. Even the best investors get it wrong sometimes. No matter what happens, stay focused on the fundamentals. Dollar cost averaging into the market over time, reinvesting your dividends, and keeping your investment horizon at least 5 to 10 years, ideally longer. These principles should serve you well. The S&P 500 isn't a get-rich-quick scheme, nor is it risk-free. Markets go up and down, recessions happen, and you may lose money in the short term. But as Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. Don't panic when the market falls. Stay the course. Time is your most powerful ally. In conclusion, the S&P 500 offers a compelling proposition for long-term investors. Its blend of diversification, low fees, simplicity, and historic performance makes it a compelling choice. Sure, there are alternatives like international index funds or emerging market funds that offer exposure beyond the U.S. economy, and there's nothing wrong with sprinkling some of your portfolio with those options. But for the majority of your investments, the S&P 500 is hard to beat. If you found this video valuable, please show your support. Subscribe, hit the like button, and leave a comment below with any questions or thoughts you have. And hey, don't forget to tap the bell icon so you never miss any new videos from us. Thanks for joining me today. Until next time, all the best in your investing journey.